What if you could stay invested in the market, capture the upside when things go well, but also have some built-in protection when the market takes a dive? Sounds almost too good to be true, right? Well, today we are pulling back the curtain on something called Buffered Index ETFs. And if you've ever felt nervous about losing money in the market, this conversation is definitely for you. Welcome back to Intentional Wealth with Tiffany Tippins, the podcast where your money is aligned with purpose and your wealth is built with strategy, legacy, and intention. I'm your host, Tiffany Tippins. Well, welcome to Intentional Wealth with Tiffany Tippins. I'm so excited about our conversation today as we will be talking about Buffered Index ETFs. I have with me Matt Summers, who is the National Sales Consultant for Innovator, and just excited, Matt. Welcome to the show.
Appreciate you having me. Thank you. Excited to be here.
So, tell me a little bit about your role with Innovator. We talked a little bit how you help firms like mine. And I was so happy to get your call because I've been looking at this investment strategy as an alternative for some clients that I'm working with. So tell me a little bit about your role first and how you help advisors in this space.
Sure. Yeah. So I've been with Innovator for the past 6 years now. I've covered a handful of different territories, mostly on the East Coast. But probably almost a year ago now, I switched over into my newest position. I cover the U.S. For these models or pre-built portfolios at Innovator. So really my job is to help educate advisors. I mean, we've been out for almost 7 years now with Buffered ETFs, but there's a lot of education, a lot of implementation to be had. Just do my best to cover all the bases, be transparent, weigh the pros and cons with advisors, and really help them set up their clients for either way the market goes with our Buffered ETFs.
Awesome. And so what I love about this strategy is in the world of investing, there's so many different types of securities. And also in my world as a small boutique registered investment advisory firm, a lot of people think like, how are you kind of doing all this by yourselves? But it's because of partners like you that I get to work with that bring me awesome strategies to say, have you considered using this in your practice? How many firms do you all work with? What is some of the type of work that you do with advisors like myself?
Yeah, I mean, we work with firms all across the country. We have thousands and thousands of clients. We manage about $28 billion now. And we've done about $3.5 billion just this year. And so really, we work with RIAs, independent RIAs, broker dealers, institutions. We're now in some hedge funds. So it's really across the board. We're now getting our feet wet in the wires like Morgan Stanley and some others. So the whole buffer ETF space is blowing up. And kind of as it should be. We pioneered the space almost 7 years ago. Just in our suite now, we have 150 plus different tickers. There's 300 of these things out in the market right now. There's a lot to choose from. And I think a big reason for the growth is a lot of teams are looking at these ETFs and they're like, hey, these ETFs are something that we can scale into our book. I don't have to do
absolutely
300 pages of paperwork to get a buffered payoff profile in my book. It's just a click of a button ETF. And prior to us launching them, that wasn't possible. So yeah, you're going to see a lot of these out in the market. The space continues to grow. We now have, more than just buffers. We have income stuff. We have accelerated non-leveraged. We have dual direction. We have a lot of really what's mimicking the annuity structured note space. We're now just packing into the ETF space.
Awesome. So one of the platforms that you're on, which is my custodian, is Altruist. And I work with Altruist and Charles Schwab with my clients. And you are connected to Altruist, which I love Altruist. They're open architecture, and I get to create portfolios and do my little magic there with clients and bring strategies like these to the marketplace. So tell me a little bit about your relationship with Altruist and how long you've been partnering with them.
So Altruist, we've only been a partner with for probably 8 months. We're on a bunch of other platforms as well. I mean, I really just started taking over our model, our pre-built portfolio space, December last year. So we're now on 10 different platforms. Altruist is, I think, one of the best to work with. They're more RIA focused. They have a really nice platform, like user-friendly
Mm-hmm.
analytics and management. I think it's just overall a very clean cut platform
Yeah,
compared to
yeah,
some others where it's just anyone who pays gets on board and
exactly.
there's a gazillion things to choose from. Altruist is much more dialed in than that. So,
Mm-hmm.
yes, for the past 7, 8 months, it's been wonderful to
Mm-hmm.
work with Altruist.
Awesome. And it's been easy as well introducing it to my clients. The portal is usually user friendly. They can go on and see their portfolio, log in, understand what they're looking at, and they provide tons of education. So let's just talk a little bit about buffered index exchange traded funds, kind of how they came about. I know they started a little bit around 2018 with the need of a change in strategy for a
Yep.
lot of investors wanting some protection from the market. Can you give us a little bit of backstory of how this series of securities started?
Definitely. Yeah. So just some background on Innovator. We're the pioneer and the leader of the buffer ETF space. So our two co-founders were the same two guys from PowerShares back in the day. PowerShares created what you know probably as QQQ, the very
Mm-hmm.
popular NASDAQ ETF. So they were at PowerShares. They sold PowerShares over to Invesco. That's now the fourth largest, ETF provider out there in the world. So they sold that over to Invesco back in 2007, 2008. They went into retirement. And then after a few years, kind of the story goes, one of them went to go buy a buffered annuity. Really, he was a younger gentleman. He didn't want the lockups and the constraints, some of the, illiquidity and, you know, not super transparent sometimes, I guess 15 years ago, kind of wrapper. So in retirement, he said, well, we've done ETFs before. These bank and insurance products are really just kind of wrapping those options packages up in annuities or structured notes.
Mm-hmm.
Why can't
Mm-hmm.
we do that in the ETF wrapper? Again, a lot of you listeners know ETFs, they're all liquid, they're tax efficient, it's a great investment wrapper. And so that's what they did. So 2017, Innovator was started, and we launched the first buffer ETF back in 2018. And so really what a buffer ETF does is it gives you index exposure, S&P, NASDAQ, Russell 2000. It gives you main benchmark index exposure
Mm-hmm.
um, over a certain period of time, just like an annuity. In the case today, we'll make that, let's call it 12 months. So you're
Mm-hmm.
tied to the S&P. You have an upside cap over 12 months. And in exchange for you taking on a cap, you have built-in downside protection or buffers. So like a buffered annuity or a buffered note, that protection protects you for the initial downside loss. So let me give you an example. Today, our 1 year 15% buffers have about a 12% cap. So right now,
Okay.
if you bought one of our buffer ETFs today, for the next 12 months, you have upside exposure up to 12%, and you're protected on your downside for the first 15% of loss. So it's just like you're buying the S&P with guardrails. It's all
Mm-hmm.
liquid. It's all tax efficient. There's no lockup periods. There's no surrender charges. There's no penalties for getting out early. There's also no credit or counterparty risk. So we can dig into that in a little bit, but that's the overall gist. It's really just guardrails on benchmark indices.
So I like to kind of coin it, and I love the illustration you gave between an annuity and the indexed buffered ETF, the comparison and contrasting those two different products, because a lot of people think, oh, I either have to be fully in the market and not necessarily protected, or I have to be locked up in an annuity for 5, 7, 10 years. And that's certainly not the case. What brought about the engineering of these types of securities? Do you think it was the stock market crash of 2008 or
Yeah,
the tech crash?
it really wasn't coming from like a certain crash or anything like that.
Okay.
Buffered annuities, buffered notes, structured notes, they've been out there for a long time.
Mm-hmm.
And there's for sure a use case for annuities and structured notes. Some
Mm-hmm.
annuities or some notes you can get, a higher upside cap, and you can
Mm-hmm.
lock that in for 5 to 7 years. So yeah, I'm not saying like, buffered ETFs are just for sure better than the other products.
Mm-hmm.
But I think where our co-founders saw a need was, well, if you're in retirement, do you have 5? Do you have 7? Do you have 10 years to be locked up?
Mm-hmm.
When you're in retirement, a lot of times, older clients need to take those RMDs. They need to take money
Mm-hmm.
out. They have to live on it.
Mm-hmm. Mm-hmm.
So really, when we first launched back in 2018, a lot of the rules in place for buffered ETFs were not there. The
Okay.
the main one being is we're able to wrap the options basket. I won't go deep here.
Mm-hmm.
We're doing the same thing as bank and insurance product
Mm-hmm.
firms are doing, the exact same
Sure.
thing. But we're wrapping that package up in a liquid ETF,
Mm-hmm.
not the annuity, not the structured note. So the liquidity, that was the big need here. It's yes,
Mm-hmm.
there's a bunch of other vehicles that give you a very similar payoff profile to annuities or structured notes, but we want
Mm-hmm.
it liquid. So liquidity, I think, was just the overall consensus of how do we get the annuity and the structured note in a liquid ETF, one that you
Okay.
can buy and sell daily and have it fully tax efficient.
So you mentioned a little bit about kind of who this might be for, because this product might not be for everyone. One, certainly someone who's in retirement, possibly have the need for liquidity, and it could be a strategy where it's not fully your entire portfolio, but a portion of it. How would you see the right buyer for this? Possibly not necessarily a retiree, but someone who is a little bit maybe more conservative with the
Sure.
portion of their portfolio. What are some ways other advisors are using this for investment strategies for their clients, and what type of clients are those?
Yeah. So I would say out of our 28 billion under management, almost half of that is in the S&P 15% buffer. And the reason for that, like I mentioned before, the S&P 15% buffer has a cap of about 12%.
Mm-hmm.
So when I mention older clients, pre-retirees, retirees, this is a
Mm-hmm.
way to stay fully invested, not pile all
Mm-hmm.
your cash on the sidelines, and
Mm-hmm.
for the next 12 months say, hey, 12%, that's more than enough to hit my return objective.
Mm-hmm.
My objectives or our clients' objectives range around 7 to 9% usually. That's the objective. So a 12% cap, more than enough hits that. And then a 15% buffer, that's the nice middle of the road. That is a very conservative hedged downside. Now, in my example, in the next year, if the market drops 20% in the next year, you are protected for the first 15, meaning you're only going to be down 5 at the end of the year.
And you're still invested in the market.
Fully invested, yeah. So you can have a lot more equity or S&P exposure without really taking on that risk. And you still, so one of the pushback that we sometimes get from like a retail client or your clients is, well, Matt, you know, you're not getting the full upside, it's a cap, and you're being protected on the downside. Correct. So Matt, why don't I just invest half of my money in the S&P and keep the other half in cash? Right? Kind of makes sense. Well, in that scenario, if you're holding half of your money in cash and the S&P goes up 10%, you're only up 5 because you're sitting in cash. It's a big cash drag. With our products, you stay fully invested. Market's up 10, you're up 10. Market's up 11, you're up 11. Market's up 12, you're up 12. Now, if the market's up 20, you're going to be hitting your cap at 12.
Exactly.
And that's your trade-off. But you're playing with the market up to that cap. And just to be clear, that is not Innovator taking whatever profit the market goes above the cap. All we take out is the 79 BIP expense ratio. Yeah, that's where the majority of, I guess, starting to invest in buffer ETFs lies. It's equity exposure, getting cash off the sidelines. We've also seen, Tiffany, you have access to this on your platform specifically. You have access to our 100% buffer ETFs. 100% protection on the downside of the S&P, and your upside cap is about 7.5%. So it's a great way, again, if you have any cash that you really want to be protective of, you don't want to lose, you have access to 100% buffer on the S&P with an upside cap of 7.5. I think a lot of, or some of the listeners might think, well, is this like a bond alternative? It is. I would say if you're in like money markets or you're in CDs and you're not really like living off of that income, you don't need the 4.2% of whatever it's paying out now pre-tax. You can tie your safe dollars to the equities with our 100% buffer on the S&P and give yourself 7.5% of upside exposure. And one thing I would just mention is the tax aspect. Your fixed income right now, your money markets, your CDs are paying about 4.2. If that isn't a taxable account, you're going down to 2.8, 2.9.
Exactly.
So the tax part here is a huge, huge benefit. So not only are you tying your safe dollars to the S&P now with 7.5% of upside, you're going to have a better tax rate than ordinary income.
So a couple things that I'm hearing, who you already said who this is for, right? Who this is not for is somebody who's chasing high returns, right? So
correct.
if you want to be fully in the market, and like the S&P last year, I think did 26%, and you want fully that 26%, this is not for you. If you don't want downside protection from the market, if it goes down, this is not for you. But in summary, who it is for is someone who wants the best of both worlds, who's willing to give a little bit of sacrifice. And this is why I do the planning, because just what you said, some clients they may only need a return in retirement 10, 12%. I had a client that I recently did her plan, and after all was said and done, she only needed a 6% return. So she didn't need the 26% in the S&P, and she was more concerned about what she had saved and protecting that going into retirement versus, having the risk and the dip from the market. So it does give you a couple of options on, hey, like you said, if you've got money sitting in CDs, and I've seen this where people, why do you have $100,000 in a CD? It's really not doing anything for you. And they're not understanding the tax consequence of, yeah, it looks like you're getting that 4 or 5%, but after you've been taxed, and then a lot of times that tax from interest, because they're getting that 1099, right, is pushing them up in their tax bracket. So it is pretty much defeating the purpose of savings to a certain extent. You still can be protected from the market, kind of like having a seatbelt, while you're still having exposure to the market, but that downside protection is what is kind of holding back that volatility. You talked a little bit about costs, 79 bips. For most investors, they don't really know how that calculates to their return. So can you talk more about, what the cost is for having the exchange of kind of having insurance on your portfolio?
Sure. Yeah. So when we say 79 bips, for this conversation purpose, let's just round it up to 80 bips. And 80 bips means 0.8 of 1%. It's less than 1% if you put, $100,000 in, this would cost $800 per year. And that's prorated. It's not like a front end where you put 100K in and we immediately take 800. Now, 0.8 of 1%, it's a higher cost than the average ETF out there. It's a higher cost than all of your index ETFs out there. But for how we justify that, and again, that's all we take is 0.8. Whatever caps, whatever upside that we get, we give it all to the client. We're a fully transparent firm in that. That's all we take. There's nothing hidden. There's no hidden fees. We're also not getting a 13% cap and advertising 12. So we can scrape off the 1% on the top. We're not doing any of that. Whatever we get, the client gets, we tack on 0.79 of 1%. And again, I mentioned it is a higher cost than the average ETF, but when you actually look at the other vehicles, the investment vehicles, when you look at things that give you a buffered exposure, a protection on the downside, you are looking at buffered annuities or buffered structured notes. Our cost is generally a fraction of the annuities or the structured note cost. You're probably going to be paying 2.5% to 4% in the other vehicles. So again, I'm not saying that we're replacement. There is definitely a need for annuities, structured notes. Everyone's different in their investments, what they're comfortable with, what their risk profile is. But yeah, it's generally a fraction of the other vehicles that you're going to get this payoff profile in.
So I think, for the right client, because I use a variety of strategies, it really just depends on who the client is. In most instances, I may have a client who needs a portion of this for their portfolio if they still want to be in the market. And, we'll use this strategy, but we will also use an annuity. So you can pair this with an annuity. Like you mentioned, some of the differences between this and annuity, the annuity is a little bit more long-term because it may be giving you other features that you need that you may be lacking in your portfolio. Like a bonus, or like inflation protection, or like long-term care, terminal illness services. So, or guaranteed income. So when we look at repurposing our dollars, we look at, okay, what bucket are we going to pull out? If it's, I need guaranteed income, I'm probably going to look at an annuity because that's going to lock it in for the lifetime.
Yep.
And I'm okay with this portion of my money of paying fixed things like, hey, I got to have food, my mortgage needs to be paid, my car needs to be paid. But for other money, like, hey, I could still be in the market, I can lock in and that vacation that I want to go on to, Paris next year, or whatever long or short term, I could put that money into the buffer because it's a little bit more short term, still participate in the market, still can participate up to the caps. But on the downside, I'm not up at night worrying about, if the bottom is going to fall out and this other 100,000 that I have, am I going to lose, 20,000 tomorrow, or is it going to be 15 when I can't stand to lose, a certain amount that I'm not comfortable with? So you can have the best of both worlds if you're willing to look at what are you missing in your portfolio.
Yeah, yeah, yeah.
Um,
The annuities offer a ton of those characteristics. The other add-ons, yes, our buffered ETFs, just for listeners, they're all just price appreciation and growth, like set it and forget it type of growth.
nice. So, I mean, with saying, kind of where we are with the economy now, this sounds like, there's a lot of uncertainty. Let's just be honest with what's going on. Is the Fed going to cut rates? Obviously, we have to let listeners know that this product is a defined outcomes based product. So you're going to know that you can get the upside cap. You'll still have growth in the market, up to 15% or up to 7%, depending on what option you have. Or you can have 100% of downside protection, or 20%, and that's contingent on the type of portfolio you select.
Correct. Yeah. So for the listeners, Tiffany, you have access to kind of really four levels. The more protection that you want, the less upside that you'll get. But yeah, for you listeners, you could choose 100% protection. You could choose a 25% protection. 25% of protection on the S&P is an immense amount of protection. You could choose 15, and then you could choose 9. So it's all kind of like a gradual level up, and you get to choose what you're comfortable with. But yeah, Tiffany, to your point, there is a lot of uncertainty in the market. And that is exactly why buffer ETFs have grown like they have. I mean, we just launched these in 2018. We're not like an old firm by any means, but right now we're sitting around 28 billion. The whole industry is almost $60 billion within less than 7 years. So it's a huge industry, and it's not because of like past performance and it's all, buffer ETFs were great and now they're gonna be great. This is more of like a forward-looking product. This is a position to put yourself in for either way the market goes. There's no guesswork. Here are your guardrails for the next 12 months. If the Fed does cut rates and equities pop up, great. You have a 12% cap. If the Fed reverses or a war happens or whatever, Nvidia gets, fraud, whatever, who knows? The market tanks. You have a 15% or you have X percent of protection on the downside. So it's really just who cares about the uncertainties? Here are your guardrails. You are now positioned for either way the market goes. There's no guesswork.
Matt, talk to us about what type of accounts can we use these investments for? Because I work with many high income earners who may have brokerage accounts or IRAs, but I also work with business owners who might have their SEP or Simple as well. So can you talk a little bit more about maybe what types of accounts these buffered index ETFs can fit into?
Yeah, so really it's qualified, non-qualified brokerage accounts, whatever account that you can put an ETF into, you can choose your own ETF, you can put these in. A lot of 401k platforms, they're very selective depending on what you have. These probably wouldn't be available in the 401k space, but anywhere where you can plug in an ETF, you can plug in our ETFs.
Okay, awesome. So
Yep.
for people who, again, just to summarize what we've talked about today, who have their money in CDs or savings accounts or under the mattress, or even people who have money that they haven't rolled over, they're not sure what to do with it, they're afraid of the market. Sounds like this is another option for them to consider with having some upside protection while also having, we said, that seatbelt that protects them from the downside of the market. Any final or closing remarks that you'd like to let our listeners know today?
Yeah, so typically towards like the end of these calls, we get a few of these questions come in. The first one being, who's Innovator? Are you guys small? Why shouldn't I go with one of the top dogs out in the market? I mentioned earlier that there's zero credit risk and zero counterparty risk, meaning you are not tied to our balance sheet in any way, shape, or form. Even if Innovator didn't exist next week, you still have your full strategy to play out. So yeah, we're not betting against our clients. We're not setting this up. We're not tying our balance sheet to yours. Really, what that boils down to is the next question of everything looks great and sounds great. What's the downside of these? These are ETFs with guardrails. The
Right.
downside is that you have an upside cap. The downside is that you're not going to get 20+% a year in these things.
Exactly.
The objective here is to not lose your money in the red zone, in the retirement years. You can't afford a 20% drop when you're about to retire or you're in retirement. So losing less here means a lot more to our clients. So that's the downside of the product.
And
After
let me
that,
tell you, I've seen, I wanted to just make this one remark to that. When 2008 happened, I saw a lot of people very frustrated that who wanted to retire that year couldn't. They had to
yep,
work another couple years until they got their money back. The market started going back up. So the point that you're making about, hey, yes, this is not for you if you want, the full upside of the market. If you're someone who's going into retirement and you still want to be invested, and I tell all my clients, just because you're in retirement doesn't mean your money should retire. You should still be invested in the market. You need to position yourself to make sure that you're still protected and investing, however, that you have some upside of the market. So I'm glad you said that, for someone who's considering retirement, and that's even somebody who's planning on going into retirement in the next couple years, you're not there yet. This is a good product to consider.
yep. The last thing I would cover is some older clients from past products, they have like a bad experience in a buffered whatever, or it gets called away at the wrong time or something like that, whatever happens. The last question is, we love the story, but is it possible to blow it up? Is there some scenario where these buffer ETFs would not work? What is that scenario? The only scenario where buffer ETFs would not work is if there was a full market collapse, government included. So without going too far into the weeds here, if you own our actual ETFs, you actually own that options package underneath. That is backed by an options clearing corporation, who's then backed by the US government. So that is the only scenario where these things would not work. It's a full market collapse. We are hunting and fishing and trading bullets at that point. So,
and if it does, this is probably not the only problem you will have.
correct. Yep.
So I would totally agree, but thank you for those disclaimers and letting our listeners know what are the pros and cons, because when we do look at, what investment options are out there, what investment strategies that we can use these options, and who's the best, who's this strategy is going to be best for. Obviously, we want to weigh the pros and cons at every level.
Sure.
Thank you, Matt, so much for coming on Intentional Wealth with Tiffany Tippins. I'm excited. I mean, this is why we do this and offer this education, because we want to make sure that we're aligning our money with intention, legacy, and strategy in mind. Thank you so much for coming on and educating my audience.
Appreciate you having me again. Thank you, and we'll talk soon.